Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, March 16th, 2022, aka Fed Day. We're going to have the FOMC announcement at 2 p.m. We pretty much know what the hike's going to be, or most likely. I'll talk on that real quick. Let me throw that out now. Let's just say, what if? That kind of reminds me of the poem by Rudyard Kipling. If he's talking to his son, if you do this and that, and then you'll become a man. Well, what if Powell said he's going to vote? Which again, I give you my criticism. I'm quick to criticize the guy. I think he's doing horrible things for this country by stoking the flames of inflation. But let's just say that the board overrides him. I don't know the inner workings. I know he's kind of boss man, but everyone votes and the committee meets. And let's just say something happened and they do a 50-point rate hike. Obviously, that would rattle the markets. Now, I will say the odds are very low of that. The Fed, this Fed, unlike Fed of many moons ago, the last thing on God's green earth they're ever going to do is surprise the market. In fact, they've gone to this ridiculous, what I believe ridiculous transparency where they telegraph everything they're going to do as far out in advance as possible, which then of course they end up backpedaling and eating crow and changing that. So I take what they say with a grain of salt. This Fed, I can just tell you, and I've said it 3, 4, 5 chairmans ago. They're completely reactive, never proactive, and so we'll see what happens. We'll see what they do. And again, okay, so let's forget about there is that possibility. It's remote, 50 basis point rate hike, and that would just utterly shock the markets. But I'm going to talk on technicals, how to trade it, and everything else. So let's just go with the assumption we're going to get the quarter point, and then again, it's what does the Fed say? What else do they do? How does the market take that? And again, at the end of the day, it's all what you can't really see, or it's not anything tangible, but it's what we read in the charts. It's supply-demand dynamics. There's a lot of other things that can happen. The U.S. market, especially the big tech bubble, not tech bubble, but tech stocks, which were frothy and full of hot air, they've come down really hard. I mentioned a week or two ago, I read about one big hedge fund, and it was a long short fund, that like a traditional hedge fund, what they're supposed to be hedging, doing long and short bets, closing down from underperformance. What I wonder is how many have blown up or close to blowing up. With not just the market. Again, the market's not down enough to most likely to trigger any major fund collapses or problems with the broker or anything else. But now you have Russia going offline completely, and those assets being marked down to next to nothing, and even the risk of nationalization from Russia. I've read about planes that are being left there. Putin authorized they can nationalize, take those over, or nationalize other assets for foreign companies. So that's all I'm trying to say is there's still a tremendous amount of risk in the landscape, but the charts are bullish. As you know, yesterday I did a partial, not a full, but a partial pivot on my stance and told you that, despite my previous comments, I was going to lighten up on even my long-term trend positions because of the technicals in the chart and the potential. I'm saying all the things bad that can happen. Well, things good that could happen. Situation in Ukraine, Russia can abate. Maybe everything is fine. There's no major fund blow-ups or other cracks in the financial system that have occurred with the recent drop in U.S. equities, as well as especially Russian equities and debt and everything else that's been pretty much taken off the market. So let's just look at the charts. Okay, we can sit here and talk all day long on what could happen, what may happen, what the Fed may or may not do. Let's talk technicals. Okay, so the reason for my pivot is stated yesterday. Again, I'm calling it a partial pivot, not a full pivot. And please, again, I say this over and over, but I know there's always new people to cite. Please do not be confused with my active trading or very near-term outlook for the market. Intermediate, long-term. Sometimes one has nothing to do with the other. I can be absolutely all-out, get-out bullish or bearish long term on a commodity or the stock market, and then all in, bullish and long or the opposite direction, as recently. So right here, for example, throughout, a long trade idea for active traders, go long here. We had nice positive, aka bullish divergence. We were testing the recent lows, and as I said, it was good for at least a 5% quick, less than 2 full trading session gain, if you close out this morning, and 7 if you played the bounce. I did post, I followed up to that chart because you might not see the bounce, and when you look at the future, 60 minutes a large time frame, but there it is here. Well, you can see it here when I go in real tight. That was the first target on NQ, 13,390 right there. We hit it almost perfectly, a slightest overshoot, and that was good for a little over a 1% pullback. And that was just as my arrows had drawn, and then going up here. And so if you were an active trader and you gamed that, I would have put, and I did put, very, very good odds on a reaction on the initial tag, and then that's it, followed by another thrust up. So then that gives you about 7% so far. I don't want to, beat a dead horse here, reiterate what I said earlier too much. But again, yeah, that was my target up here, the trend line. Why'd I sell today and with room to add and reverse? Because as I said, all eyes have to be on that level. It's to me, a very prominent trend line, and in volatile markets, that's where my TA style tends to shine, when there's high volatility and a lot of confusion in the macro situation, the fundamentals, because that the analysts on Wall Street that are sitting at a desk trying to crunch, looking at hindsight analysis, mostly balance sheet, earnings, latest earnings, quarterly forecasts, things like that. Well, the outlook changes rapidly at that point. So it's much harder to use fundamental analysis in a rapidly changing macro environment, and that's where it's been my experience where traders flock to technical analysis. The computers take over to a large extent, meaning algos, firing off buy and sell programs on pullbacks to support, rallies into resistance, things like that. And traders also kind of step in and start exacerbating those moves by also trading off those same levels. So that's what we're looking at lately. And again, my point being that if everybody's holding out for a move to this, you may get that. You could even go past it. There's no guarantees of anything, but I can tell you that if all eyes are looking there, I'm not going to hold out for the last half percentage point and miss out if everyone steps in and takes profits early and thinks along the way same lines I am. So I'd rather be there and leave enough room. Hey, if we do get a full tag, sure, I can add a little there as well. But that's what I'm expecting. So number one, that's why I'm expecting the reversal a little shy of that target. So this is effectively my target hit now. Call it revised, call it what you want. That's why I got the post out to you as quick as I could this morning. The other thing too is it is again Fed Day. The market, as I told you before, is always going to be volatile, especially on a big market moving FOMC announcement the days leading up to it. So what I'd say is any active traders, maybe even some investors, anybody that caught any or all of this big spike up in the last couple of days, you have to ask yourself, why wouldn't they be wanting to take profits and lighten up in front of the Fed? That is the most logical assumption, that you're going to see some profit taking on a big rip. Just like if we had dropped down, let's just say the last couple of days had been a big move down, likewise you'd probably see a lot of short covering, because that would have pushed a lot of that down, and maybe dip buyers stepping in, and I would expect a mean reversion. So for those two reasons, I put at good odds, and I'll be pretty, again, active trading stuff, pretty aggressive short going into 2 p.m. today. Come 2 p.m., I'll most likely lighten up. The charts move so fast then. I'm going to continue to get my thoughts out and probably do one more video before the end of the day. I just want to kind of talk on near-term stuff. And then there's this trend line. There's this 60-minute trend line. I showed it to you on a 5-minute chart, but the trend line was a little bit different the way I showed it. But there it is. You have this uptrend line on the 60-minute chart right here. which will most likely trigger a sell-off. Where to if you're just day trading? Well, right here. You got a line, some minor support right there. I'd say that is a minimum target for today. If we get profit taken from the Fed, that's 13,471. You can just do a comparable. That was that flagging action yesterday after the pullback, the initial pullback. Again, that'll be right here on QQQ. Oh no, you don't see it here so much because NQ, that was when NQ was trading overnight, so I take that back. And that's why, again, that's why I like to use NQ. And I always say this, even if you don't trade futures, don't have a futures account, keep an eye on them. They're going to help with your QQQ trading, or whether you trade SPY or IWM. Watch those futures as well. So that's it. That trend line, probably break this today. Any push up to that level or just above it at 13,387, I would view also as an objective shorting entry. But this is where I prefer to reverse for a quick pullback trade today, and then kind of sit back and let's watch the fireworks after 2 p.m. today. The other things you might note down on the PPO down here, and I'm sorry, yeah, the PPO. I've done this recently. I gave you on QQQ high-level bearish. High-level PPO tags, and you can see it here as well. Look what happens. That seems to be, this red line I put, it's at the 0.9 level, seems to be about as high as a PPO gets. Came very close there, and we're getting up there and we're rolling over. So you usually get, at least as you can see here, when you get to that level, a pullback. Quite often then you put another thrust up, make a divergent high. But either way, when you hit that level, boom, you initially get checked. At least you have in the past. Even there was a little one. And then again, after each of these, you had divergent highs, and then a much bigger drop came. So that's an idea. That's, a pattern that may or may not repeat. It might look something like this, maybe a pullback into the Fed, a rally, and then a divergent high here. So watch this. Watch that PPO, and just know, again, it's a function of the market being overbought. You can see the RSI as well. I didn't comment on that, but you can also see the RSI pinned up at an extreme level right there. In fact, the RSI on this 60-minute time frame has not been this high. It hit about the 82 level since back here. And again, there it had a divergent high and then a big drop. And that's it. So we're extremely overbought. And so that's why near term today, I'd say probably that's your upside is minimum and is smaller than the downside potential should we get some profit taking closer to the 2 p.m. thing today. And then let's not forget, this is a powerful pattern here. This is a 60-minute chart. But before I finish the video, I'm going to go over the daily charts real quick, and also a lot of the big market leading stocks, and tell you again why I made that partial pivot, and not writing off my targets. I believe they'll be hit this year. It's just a matter of, are they going to be hit, in the next week or so, next couple weeks, my next downside targets on the weekly chart, or might we be looking at a rally that could last for a few weeks, even a couple months, and then see another leg down. I certainly am not going to stay short if that's the case. That's why I wanted to get my thoughts out to you guys. All right, let's look at QQQ. Here's the 60-minute chart, the one we've been trading. There's your comparable downtrend line to that on the futures. Very, pretty clear again, and again, big divergences. These are what I like to trade. It's a big part of my trading. It's not everything, but it is. They're highly effective if you can identify and use them right. 33.74. These are all the levels I had on the chart for a while. We hit that. We hit it in pre-market, and we hit it again. So we're right there right now. And again, to me, try to measure it out from where we're at right now. You're looking at about a 0.62% upside if the trend line's hit, and there's price resistance there. So I'd rather book profits on those longs that I took from here the other day. Got the reversal, showed you on the 5-minute chart, and game it. Look, there's a big old gap here to be backfilled. So that's if you're looking for targets. If we enter the gap, we'll probably backfill it, and then that's going to be a move down to, let's say, right about here. Let's just measure it out for you. So you're looking about a 2% pullback potential on a pullback trade today. I don't think we'll see much more than that before the Fed, but who knows? Trade it as you want. Either cover, if you're long, if you're long, you're concerned about stopping out. Where do you stop? Well, the top of the gap. You don't want to enter it. If so, then the bottom of the gap. You place your stops strategically below these levels there, of course, based on where you entered. But that's what I'm looking at for today. Potential for about a 2% pullback or so. There's also support here. Maybe we pull back to the 60-minute uptrend line on QQQ, which is a little different from the one I gave you on NQ. And now very quickly, let's just rifle through all the indexes. This is Qqq Daily Chart. The key things here, I'll turn off all the lines. These lines were on that chart, but just to make it clear, this is what has caused me to temper down, or at least be a little more flexible to the if again, depending on how the market reacts to the Fed, not what the Fed says, that doesn't matter at all. It's how the market reacts. I've seen the Fed come out in these meetings, or same thing with company earnings and watching a company stock trade. I've seen very bullish comments, very bullish outlook, and yet the market or that stock sells off. And that usually occurs after an extended uptrend where it's just saturated. The last of the buyer has bought his or her shares, and then there's no one left but sellers. And that's where stocks often peak on good news, and they often bottom on bad news. There's a saying that the dawn, it's always darkest before the dawn. That's a saying in the stock market. Think back in 2009 in March, when it looked like the world was going to come to an end because the market just kept melting down and down and down. It had already come down over 50% from its 2007 highs, and then boom, all of a sudden it was over, and it didn't appear better until, in hindsight, then the fundamentals you started hearing were improving. So just keep that in mind, and that's all I'm trying to say is don't try to interpret or decipher what the Fed does as being bullish or bearish. That's not important. I mean, you'll have your opinion, I'll have mine, but the important thing is what everybody else, i.e., all the market participants, think, and that's where the charts are a much better guide, in my opinion, than fundamental analysis. And I always caution this last thing, don't ever read too much into the initial, even the subsequent reaction from the Fed. What I mean by initial and subsequent reactions, well, come 2 p.m. you're going to see something along this line. You're going to see the futures and the indexes, QQQ SPY do this and then this, or either way. You're going to see very fast moves. And again, don't read too much into that. I call that post-FOMC noise. Algos are firing off high frequency trading, and it leads to these big rips and dips. And usually the initial reaction quite often is not the lasting reaction that sticks. In other words, you get an initial pop, 3 days later and 3 months later we could be a lot lower, or vice versa. So just again, just try not to read too much into it. But I will say this, I'm going to add to that. I also like to take advantage of post-FOMC rips and dips. Let's just say I decide to go in long or short with, let's say, NQ or QQQ. And what I'll do then is I'll allow a little bit wider stops so I don't get taken out in the noise, because stops are usually set tighter than your profit targets. And then I'll leave a profit target in play, because those rips and dips is almost seemingly random as they are, they still tend to work towards levels, because you'll have stop and buy orders set at key levels. So my example there is, let's say we're right here right now, and it was 2 p.m. and I thought we were going to pull back and backfill the gap. I'm going to leave an order in, buy to cover my position there in case we get a quick swoon down. Boom, my target's hit, and then we reverse from there. So the goal in any trade is to not be stopped out, but to hit your price target. And so I take advantage of volatility. Leave those sell limit orders in place again if I'm actively trading. So that's just kind of a tidbit. All right, back to the longer term stuff, and then I will get this video out to you guys. All right, so back to what I was saying there. That's QQQ positive divergence on the daily chart. I don't see that often. That is typically especially in a bull market, which I'm still viewing this as a primary bull market, despite the fact Nasdaq's dropped over 20%. I talked to, if you're new to the site, these are my primary trend lines here. This is the bull market that we're in right now, and the old definition of a bear market being a drop or 20% or more off the highs is antiquated in my opinion, especially with volatile. Every sector and every index and every individual security is different. If you try to use a definition of a 20% or more move up or down as a bull or bear market in natural gas, in Bitcoin, Well, that's ridiculous because it's going to have bull markets every week. So again, use those. Those terms are relative. What defines? And I don't have a hard number. I can just tell you this is a cyclical bull market in QQQ. I still think we're going to hit this trend line. It's already been called a bear market by the media, but to me, it's just a bull market correction, one that we've certainly navigated very, very successfully lately, and hope to continue to do the rest. But right now, I'm a trader, an investor, and by nature you have to take risks there, but I'm not an outright gambler. I like odds in my favor. I'm not going to sit down at a table where I've got 50-50 odds or less. You go to a casino, every game you're stacked against you. The odds are, walk in the door, whether you're playing slots or um, blackjack or whatever. So that's why this is where I prefer, and I like to put odds clearly in my favor. Doesn't guarantee you're going to be successful in every trade, but it helps out. So like I said, holding into the Fed today, a heavy position, long or short, is a kind of a crapshoot. All right, back to the charts. QQQ, positive divergence on the daily time frame. SPY, remember these all had it on the 60-minute as well. I'm just going through the daily charts. SPY, the S&P 500, that was a big divergent low. Positive AK bullish divergence at that low. But yet we're still below trend. We're still below the key moving averages. So you have the intermediate trend indicators have all flipped bearish on the equity markets. We are in a downtrend. So you have to consider that and take that. What that means is while I love going long after divergent lows, especially when something has hit support with positive divergence, I'll game it actively. I'm talking about more of trend trading. I also recognize that in a bear market, if that's what this is, and if we are going to go on to hit my additional downside targets that are on the weekly chart, then these divergences may very well be burned through. Just like in a bull market, negative divergences often either don't play out or they start to play out, but way a lot less than their full what the scope of those divergences might indicate, or they don't play out at all. So what that means is, if whatever happens, and as long as we don't exceed, I told you this is really my, if you want to say a line in the sand, both on SPY and QQQ. I had those topping patterns there, those recent ranges that broke down, and on SPY was back tested. That's my line in the sand. Before that, you still have to get through the 200-day moving averages. So there's a tremendous amount of resistance overhead. There's downtrend lines. So this is, it appears to be a bullish setup, but just like trade setups, I'll give you an example. MBII yesterday, I laid out a bullish setup, but it hasn't triggered. And so I don't have a position. A bullish setup or a bearish setup is just that. It's a potential trade pending an entry on a breakout of support or breakdown below breakout above resistance or breakdown below support. And this is a potential bullish setup, and one that, again, you need to recognize, because if it plays out, great. Otherwise, the trend is currently bearish, and so if we head on down here, what's going to happen? If we take out the previous lows on all these indicators, you no longer have divergence, and that to me is uber bearish. And then at that point, I will tell you, I will reiterate, or say that, look, we're probably going to hit my second target, but if we hit my second target and the divergences are taken out, we'll most likely head on down to these longer term targets. This is SPY here, the S&P 500. This is my near term second target. And then again, if that gets hit, it's going to sharply increase the odds, especially if the divergences on all the indexes are taken out, that we're going to go on down here and hit these longer term targets. All right, back to the other indexes, because that's not the only two. You have IWM, small caps, Russell 2000. You've been building divergence. You have nice divergence at the recent lows. It's really right there at that point. There's our divergent low. Big support. It was my first target. It was hit way back here when QQQ and SPY hit their first targets, and we've been dancing around. We're in this consolidation range. This is my, again, for lack of a better word, because it's not an all-in where you flip from short to long, but that's pretty much my line in the sand. That was a big, 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 big level to me, about 208.50, multi-year consolidation, topping pattern breakdown, and we've been consolidating between the first support level slash target and that level. We had a back test. So these are the levels that have taken out. Again, we have the potential to take out these divergences. Otherwise, if we move up, a pop above that, and then a pop above the moving averages, that's going to be bullish. And we may make a run at or near those previous highs. So these are the things I'm looking for. And again, the move I think is going to be big in either direction. We could continue to consolidate. Anything's possible. Look, we've only been here for what, a couple months now, and here we were in a comparable range, measured from high to low for what, over a year. So anything's possible, but I think these markets, with volatility being high, we're probably going to break one way or the other sooner than later. And then finally, I'll show you. Well, no, let's not do mid caps. Let's just do the top components of the Nasdaq 100, and I'll wrap the video up to you guys. Again. Just about all these components. Here's Apple. Apple took out the divergence. There's an example on the PPO. It took out the PPO divergence, but still has RSI divergence right there. Again, I'm talking lower lows in prices, higher lows in the indicators. So there's Apple. And Apple the other day hit this trend line. I've had this trend line here since that was created back in 2020. And it's an uptrend line. It comes off this reaction low, and it's well defined. Here, I'll show it to you without all the noise on the chart. It's this one right here, and we hit it the other day. Is that how I had it drawn? Let's see, that's weird. Doesn't fit there. Oh, wrong reaction low. This one right here. There it is. I knew something was wrong. That's that trend line. Right there it is. So Apple hit support, and it hit, look at that, hit those 200 days. I told you those are big levels. That's where the buyers step in. They bought the 200 days right here, and we had a one-day break. I told you, don't read too much into that. Sometimes you'll move through them for a day or so, even sometimes a week, but boom, we recovered it on that green candle. So another successful test of the 200 days and another buying op for Apple. And so these are the things that need to go. Right now, there's some potential bullish, recent developments in the markets, including but not limited to those positive divergences. You have Microsoft. Big divergent low right here. That's the common theme here. These are the leading stocks. These are the market. Where Microsoft, Apple, Facebook, Amazon, where they go collectively, the stock market goes. And there's another bullish falling wedge. So that's it. I can do this all day long. There's Alphabet. Now, Alphabet's below the 200-day moving averages, but also putting in, has positive divergence, and it's hanging in there so far. Multiple tests of the recent lows right there. So this is it, guys. We're, at the point where if we can just take another leg down, it's probably going to break support, has the potential to take out these divergences. But unless that happens, those divergences are in place, and they need to be respected. And whether, again, everyone does their own thing, whether you want to start reducing some short exposure, especially in light of the FOMC meeting coming up today, or you want to start going long, building longs, you can do that. The thing about going long, you go long near support. Right now, the recent lows are support. A lot of stocks, because we've tested them multiple times. You do have some resistance levels overhead, but you go long with a stop somewhat below those support levels. That's TA 101 or Trading 101. And again, down the line, we can do them all. But the vast majority of market-leading stocks in different sectors as well. I know I'm covering a lot of big tech here and all this, but they're these same divergent lows, downtrend lines, and so these are potentially bullish setups. So Powell, the Fed, catalyst for this, Tesla, look at that, boom, could break out any day now. The catalyst for this could be just a super easy Fed that is just completely, they've already been completely dismissive and only recently come around to acknowledge inflation's there, but have done nothing about it as far as interest rates, only talked about raising rates. And again, I know we're going to get at least a quarter point, but if we get that and they're going to sit there and say, well, there's risk with the Ukraine and all this, there's always going to be something, guys. There's always going to be. And so it's just like the parent, and you guys know that if you have kids or friends that have kids, and what spoiling a child is like, and that's what Fed is doing to the market. And look, here's where I care. It's bigger picture. It is affecting society. There's a lot more have-nots in this country than haves, and those have-nots, it's getting worse for them because they don't have 401ks. They don't have house and a second house, like the wealthier do or the middle class. And so this inflation is absolutely crushing them. And so if Powell is going to cow down every time his baby, i.e. the stock market, throws a temper tantrum like it did in the last few months, and then cow down on his plans to hike rates or do what he should do, then longer term it's going to have impact. But near term, hey, look, that's all just fundamental rambling. The near term, we've got some setups here, and this market could run if those levels are broken out. I could go down the line and show you stock after stock after stock that I have these patterns on, and this is again what's caused my pivot. This was a key level I showed you weeks back on NVIDIA, semiconductors. That speaks to SOXX as well. 209, big support. That's why I had a yellow line, and boom, 1, 2, 3, multiple successful defenses of that level with positive divergence and a very clean downtrend line. So all right, let's leave it there, because I can go through this all day long and show you the same thing. A lot of key stocks still above key support. Some are broken down. Trend indicators, near term, bearish, short term, but too many trend lines that are close to being broken with positive divergences. So that's what I wanted to share with you. We'll see where we go today. And again, it's all about being flexible. If you don't know what you're doing, if this is new to you and you're getting whipsawed, take a step back. This is the day of all days and all weeks. This is the with the Fed, big Fed meeting. This is the time you don't want to be in the market if you don't know what you're doing. You're getting ground around and whipsawed around and going long and then short. Take a step back. Let's see what happens, not just at 2 p.m., how the day ends and how the week ends, because I'm just going to end it here. Here we are on the weekly chart. I'm going to my main index, Qqq, and the one I'm trading it off of. So far, we are, still below. We hit my first target way back here. We had the expected bounce. Then we broke down, and we're still below that T1, which is a former support, now resistance level. And you also have the trend line resistance. So we're at resistance. And again, we pop it bullish. Then you're looking probably a run at the 200 days, and then up there. And again, that would be my max target, where if that's taken out, it's just going to be bullish. That's all I can say right now. If anything changes when we get up there and there's some big divergence on the daily, or something else that I see, some other cracks in the market, I'll let you know. But so that's it. So these are still the targets, and there's still a very good chance, by the way, that they can be hit. So if you want to stay short, it's not that hard. You may get a whipsaw pop through there. You might want to wait till a weekly closing basis before doing anything on your positions, but and then boom, here we are. I'm going to end it here. We're right now at the trend line. I'm going to end this video and add some more. I'm going to double down on my NQ shorts. All right, guys, this has been Randy Finney with Right Side of the Chart. Have a great day.